So let's talk about directors' loans. Now, despite the name, they can be the directors' loans can actually be given to people who are not directors if they're associated with the company. The legislation around this is governed by Section 455 of the Corporation Tax Act 2010. Which the reason for that, the reason it's relatively recent is because of changes in the way directors' loans are permitted and managed as a result of, let's face it, tax avoidance bordering on tax evasion schemes that have gone on in the past. If you want to look that up, there's some quite interesting reading on it, and you might disagree with my use of the word interesting, but it's up to you. So essentially, you can take loans from a business if you're an owner of the business, or if the owner of the business agrees to give you. You can be a director or a shareholder or a relative even of those people. So you don't have to be a shareholder, but it's basically a way of taking money out of the business without paying it as a salary, and it's quite often used as well instead of a dividend. If there's not enough distributable profit to hand out as a dividend, then it can be taken as a director's loan. So in terms of, we're not going to cover every single aspect of director's loans. I'm going to talk about the tax elements today, and why you would take a director's loan instead of a dividend. The important thing really is to understand what dividends are, which is covered in a different video, so maybe watch that first, because that covers some of the relevant information that we're going to talk about here. So essentially, a director's loan or a shareholder's loan, whatever you want to call it, is instead of, when there's not enough money to take as a dividend, or you don't want to take it as a salary because of the tax elements. Now, the tax on a director's loan is actually higher in some cases than a salary, depending on your other earnings. But the point is, it's you get time to pay it back before you pay any tax. So essentially, if you take a director's loan, and most businesses have a director's loan account, and that loan can be either a debit or a credit balance, depending on who owes who. So a director could put money into a business, and then that loan becomes a creditor to the business and needs to be paid back at some point. Alternatively, the owner of the business can take money out, and then that becomes a debtor to the business, and at some point that money needs to be paid back in. So the way shareholders' loans or directors' loans work on a year-on-year basis is that if any money outstanding at the end of the financial year, over and above the balance at the end of the previous financial year, either needs to be paid back or needs to have interest or needs to have tax paid on it. So you get 9 months essentially to pay it back in before you get taxed on it. So if you take a director's loan, and it doesn't have to be one, it can be multiple, it doesn't have to be cash either. It could be that you pay for a haircut on your company credit card, and that then is posted to your director's loan account. So it could be goods, it could be stock that you've taken out of the business, it could be a service that you've paid for using company money, it could be literally a cash advance into your own bank account, it could be any of those things, but it's anything that isn't a business related expense that the director has benefited from. So if whatever the balance is on that account at the end of the financial year is what is considered the loan advance in that year. Now, if it's reduced, that's fine. There's no tax to pay. If it's increased, then the taxable element is the increase, not the full amount. So if the balance on that loan is £50,000 at the end of the previous financial year, and at the end of this financial year it's £55,000, then the taxable element of that balance is £5,000. So 9 months after the end of the financial year, that money, that £5,000, if it's still outstanding, is taxed at 33.75% at the moment. Obviously, tax rates change year to year, but at the moment it's 33.75%. The important distinction is, though, that it's the company that pays that. It's added to the corporation tax bill. It's not the employee or the director that pays tax, it's the company. You'll also know, if you're familiar with tax rates, that 33.75% is the higher rate dividend tax. Now, the reason for that is it's to discourage people taking money in this way and not paying it back before the 9 months is up. So if it's cheaper to take it as a dividend, if there's enough profit in the business to do that, it's generally cheaper to take it as a dividend because you'll pay 8.75% on the first tranche of dividend, depending on other earnings and your total earnings for the year. The first tranche of dividend is payable at 8.75% instead of 33.75%. Once you cross the higher rate threshold, then it's payable at 33.75% on dividends. So what they do is they go straight to that rate, so as to encourage you to take a dividend before you take a director's loan. So director's loans have their place because if you know you're going to be in a position to pay it back and you just need a short-term loan, it's great. You can take that money, there's no tax to pay, you pay it back before the 9 months is up, everybody's happy. The corporation tax bill isn't increased, your income tax bill isn't increased, you've taken the money, you've used it for whatever you used it for, you've paid it back in. Now, the paying back in is important as well because obviously you could pay it back in the day before that 9-month deadline and then take it back out again the next day. Now, you can't do that. They don't. Obviously, HMRC aren't stupid. They understand that people would do that just to dodge the tax. However, you can do that as long as it's in there for 30 days. So you could put the money back in, and as long as it's still in there 30 days later, then you can take it out because then it's classed as a new director's loan in the new financial year. So that kind of resets the clock. So it's important to understand the difference between salary, dividend and director's loans. They're the three most common ways that directors or shareholders take money out of a business. Salary obviously is taxed at source if it's over the relevant tax thresholds. It also reduces the corporation tax of the business because it's classed as a business expense and therefore reduces profit. Dividends are a distribution of profit, so then don't appear on the P&L at all. They're taken out after the profit for the year has been calculated and the corporation tax has been paid on that profit. It's then taxed at a much lower rate because corporation tax has already been paid on it. This causes a lot of consternation on social media among people who don't actually understand how the tax works, or maybe they do understand, they just still think it's unjust. I don't agree with that, but that's up to them. But we've got dividends on a separate video, so go and watch that if you want to learn more about dividends. And then the third way of taking money out is as a there are other ways, but these are the three most common ways. The third way is to take it out as a shareholder's loan or a director's loan. So this is when you don't want to take it as a salary for whatever reason. There's not enough profit for you to take it as a dividend. So the only available option is to take it as a director's loan. So it can be a good option. It can be a good way to utilise money and then pay it back. But the situation and circumstances dictate the best way to do that. Now, the other thing to note on this is referred to as S455 tax because it's subject to or a result of Section 455 of the Corporation Tax Act 2010. So if you do take a director's loan and then you don't pay it back within 9 months of the year end, the company will have to pay corporation tax at 33.75%. However, if you then pay that back, let's say 3 months later, the tax will be refunded. It's a temporary tax. So S455 tax is refundable once the director's loan is repaid. The reason for that is HMRC are fine with people borrowing money from their businesses, but it used to be a vehicle for taking money from the business and never paying it back and having no illusions that you were ever going to pay it back. So they've clamped down on that now, obviously. So now it's a case of, you can borrow the money from your business, you must pay it back at some point, and if you don't pay it back within 9 months, then the business will have to pay increased corporation tax. But when you do eventually pay it back, you'll get a refund of that corporation tax. A refund of the S455 tax. So I hope that's clear. Quite often, this is something our clients often struggle with. The key difference, I think, the key thing that people fail to understand is that it's not a personal income tax. It's part of your corporation tax bill. So it is a tricky subject if you're not used to it. But it's like most accounting issues. It's pretty logical. Once you understand it, it makes sense. So I hope this makes sense. If there's any issues or you have any questions on this, then feel free to reach out.